CEO of Oasis Capital Limited. We also have Andrew Shaw, manager of IESG Capital Development at FMO, the Dutch Development Bank. And then we have Nana Winful Finn, regional director for West Africa, North Fund. Joining us virtually is Mamadou Barrow, investment specialist, West Africa, UNCDF. Our moderator is Samuel Achianu, chief of party, MasterCard Foundation, Africa Growth Fund. Let's welcome them all to the stage for the next next 45 minutes, exactly. Yes, please come right up. Come right up, and then we are good to go. Yeah. Do we have our virtual friend online? Mamadou? Ah, Mamadou is there. Mamadou, bonjour. Mamadou, can you hear me? Please unmute Mamadou. Oh, Mamadou, unmute yourself. Mamadou, greetings from Accra. How are you doing? Awesome. In Cotonou. Lovely. Okay, so handing over to Mr. Achianu for the next 45 minutes. I think it involves questions as well, right? There'll be questions from the... Yes. So I'll be giving you... When it's 15 minutes to go, I'll come and stand here. Yes. Thank you. All right, go ahead.
Thank you, Kafui. And thank you all. This is the afternoon session after lunch, but there's been quite a few presentations before, so I'm sure we're all going to have a great time discussing this. So I'll let the panel members introduce themselves, but I just wanted to give a bit of background to what we are discussing today. So what this panel seeks to achieve is to explore the role of development finance institutions in unlocking capital. And a lot has been said. Now let me add this. Unlocking capital for SME financing in West Africa. A lot has been said over the last 2 days, but we wanted to put together some DFIs, some investors, to be able to speak directly to it and be able to actually also take questions from you on what you're seeing in this space and what we can do to support. The panel will also discuss best practices of collaboration between DFIs when it does happen, the best practices of transaction advisory service providers. Yesterday we heard a bit about ESOs, and SMEs as well to improve access to financing. We heard a lot yesterday also about readiness of SMEs. And this is all geared to accelerating the growth of impact investing, the ecosystem of impact investing in West Africa. The panel will explore what innovations DFIs could adopt to make them more effective in the role of catalyzing financing for development. Access to capital, as we all know, is a fundamental challenge faced by SMEs across West Africa. This has been said several times. They need billions. And of course, we recognize very clearly, and the reason why it's important to hold this dear is that in Africa, most of our businesses are SMEs, 90%. Most of them provide job creation, sustainable job creation. And development finance institutions have been at the forefront of these innovative efforts to unlock capital. Furthermore, the DFIs have not just come with capital. They've put together several technical assistance and capacity building programs. And these capacity building programs basically, sometimes in collaboration with local financial institutions, local transaction service providers, and government agencies to strengthen SMEs. So this session will go deeper into these strategies, some success stories, and come to you for some questions as well on how to improve this in Ghana and in West Africa. So without further ado, I think I'll ask my panel to introduce themselves, starting with Nana Winful, and then coming down the line. And Mamadou, we will not forget to ask you to say a few words as well as introduction. Thank you.
Hi, everybody. Thank you for having me. I'm Nana Winful Finn, Regional Director for North Fund, Norway's Development Finance Institution. Norway's North Fund is 26 years old and was set up by the Norwegian government to drive development through investments in the private sector. So we invest both directly in companies as well as indirectly through funds and platforms. On the direct side, in terms of sectors, we focus on renewable energy, financial institutions, manufacturing, agribusiness, waste management, and water. And on the indirect side, we invest primarily in funds as well as platform companies who then on invest into many other sectors, including some of those we don't invest in directly. So just by nature of the way we're set up, our mandate is dual. We invest for both commercial return and development impact. So we're in the right room in terms of the discussion around impact. In particular, our mandate also requires us to be both additional, which means taking risks that other purely commercial investors might not be able to easily take, and catalytic, meaning we bring along other investors with us. In particular, commercial or purely commercial investors is our target. And we invest primarily in SMEs. I would say more on the medium side than the small, candidly. However, we are catalytic both in the institution in which we invest in which we bring along other investors, as well as catalytic for all of the companies that are interacting with that company in its own value chain, many of whom are SMEs by any definition, not just the IFC one. So I look forward to the discussion. Thanks.
Thank you very much. It's a pleasure to be here. My name's Andrew Shaw, and I'm representing FMO today. Nana, thanks for explaining how a DFI works, because it makes my job slightly easier, because certainly amongst the European DFIs, the model is roughly similar. At FMO, we focus on the financial, agribusiness, and energy sectors, providing loans, equity, guarantees, and grants. And the grants part of the business is my shop, and I'm responsible for FMO's grants and technical assistance. And I focus primarily at the work that we do at the enabling environment and ecosystem level. So great pleasure to say thank you to IIGH and the great work that's been put into this event as well, because that's one of our key partners in Ghana, as well as our friends at Andy. Thank you.
Thank you very much. Matthew Bodweje is my name. I lead Oasis Capital, which was established in 2010 as a SME-focused fund manager in West Africa. We started with $11 million in 2011, which was successfully invested. And in 2017, we had our second fund of $50 million. That took us to Cote d'Ivoire. So now we have offices in Ghana and Cote d'Ivoire. We currently at advanced stage of closing another 100 million with an initial target of 50 million, which we think we should do before the end of the year. That is the journey so far in that respect. We've invested mainly in essential services, in education, health, financial services, food, and hospitality. We're expanding the scope to include a few other climate enable and friendly businesses as our next journey. I'm very happy to be part of this panel and to share a few thoughts that we have. Thank you.
Thank you, Matthew. Mamadou, can we hear your intro? Thank you, Mamadou. And hi, Tracy. So I'll start with Nana, and you gave a great introduction of Norfund as well as DFIs. But DFIs play a crucial role in unlocking capital for SME financing. I think given outside of the world, there are not too many solutions for SME financing, sustainable solutions. Could you share some innovative strategies and tools that the Norfund has developed to support SMEs and bridge the investment readiness gap in particular in West Africa? Thank you.
Sure, I'd be happy to. So I think first, in terms of even how we structure deals and the instruments that we use, that is one way in which we try to be intentional about addressing the kinds of companies we see in our markets who are primarily SMEs. So we can invest equity, and what we find is that that's the most scarce form of capital for many SMEs. They can find bank loans fairly easily in our markets. I mean, of course, with some nuances, access could be better, rates could be better, etc. But in general, they can find debt financing. Equ- Is that me? Okay. Equity financing, not so much. And so what we have chosen to do, and here we're a little different from our sister DFIs, including FMO, is we invest primarily equity. About 70% of our portfolio is equity. However, we're equally able to invest debt, where, much like the other DFIs, relative to other purely commercial lenders, we try to be creative in structuring to essentially suit where the company is and what its cash flow needs and profile are. We're also able to invest hybrid instruments, and in particular, we use convertible debt quite a bit. What that allows us to do for SMEs is, one, to address valuation gaps, because we often run into situations where our view of the company's valuation today is different from what the sponsor thinks. So that's a good way to bridge, where we put off the valuation discussion. We agree a framework and a timing or a conversion window in which we'll convert. And at that point, convert typically to own less of the company than we would have if we did today, because it would have had the chance to grow more in size. We're also able to do combinations of instruments, which we actually find works well, because if you take a market like Ghana, given our minimum ticket size and the fact that we can own a maximum of 35% of a company, we often run into situations where if we put in the capital the company is looking for, we would own all of the company. We don't want that. They typically don't want that either. And so it's helpful for us to be able to combine instruments, even though we don't like to do that. Now, we also have other pools of capital which are not purely commercial, similar to sort of relative to what we typically invest of our balance sheet. So we have a frontier facility, that's what we call it, which we use for higher risk projects, earlier stage projects. It's not the same kinds of volumes of capital that we have on our regular balance sheet. So we've invested about $4 billion US around the world, whereas our frontier facility is less than $50 million, for example. So it can only go so far. But the idea there is to be catalytic and to de-risk projects so that other investors who don't have some of these abilities are able to come along with us. When we invest in SMEs as well, we will often have what others call technical assistance, which we call business support. And we are actually very broad and permissive in what that can be used for. So the company matches it. It's purely grant money. And we've used it for uses as varied as management capacity building, supply chain buttressing, feasibility studies, etc. I talked already about the fact that we're a large investor in funds. In fact, Oasis is one of the funds we're an investor in, as are many in Ghana and all across sub-Saharan Africa. What we try to do there, a large part of our portfolio focuses on funds that are investing in SMEs, because we consider it important and we see it as a great extension of what we do. We can only do so many companies directly, but by investing in funds, we multiply the effect and are able to scale our impact substantially. In many cases, funds will invest in sectors we don't invest in directly. So Oasis, for example, invests in education, healthcare services, which we don't do directly, but through that indirect exposure, we are investing in those sectors as well, which we consider to be developmental. Then another important part of our business, and this is the last one, we lend to banks and financial institutions specifically for on-lending to SMEs. So in Ghana, there are many of the banks here that we're a lender to. And we actually monitor to what extent they do what the use of funds is, which is lending to SMEs. So I'd say those are, off the top of my mind, the things that we do to address this issue and be intentional around it.
Thank you, Nana. I'll come back to you if there's time on investment readiness. But moving over to Andrew, collaboration between DFIs, transaction advisory service providers, and SMEs is vital, right? It's not only the capital, but being able to get all of these things working together. What are some best practices or successful case studies of collaboration that you've experienced, and how have they contributed to the growth of impact investing in Africa?
Yeah, thanks for the question. I've had some reflections over the past couple of days, and we've heard sort of many interesting things on the stage, and one of the key things that I'm taking away with me is that collaboration is really crucial in this space, and I know that's been said many times, but I genuinely think that there's an opportunity to identify which partners are doing what and find out where are the spaces that need to be kind of addressed and to improve efficiency. Because there's a lot of capital out there, and it's really important that it can flow like a lightning bolt to ground, right? And in order to do that, these sort of topics around efficiency and collaboration need to be addressed very well. I think sort of one of the initiatives that we've been involved in, and this is a shout out to an event that's happening next week in Dakar, is with Africa Arena and the ASIP program that they have, where they're working with entrepreneurs and providing those kind of transaction advisory services, because I think that that is indeed sort of a part of the puzzle that needs to be addressed well. And alongside that, you also need those talented capital allocators on the ground that are able to deploy the capital in a good way and enter into the sort of the growth phase that I think you were speaking about earlier, with the sort of the 10 million to 50 million to 100 million. And Nana, Hamdia, you also alluded to that in your last presentation, where that is sort of like a natural trajectory, and keeping those dots joined is really important. Yesterday, we also heard from Sam Yebo, who was talking quite eloquently around this topic of fund economics, which really sort of it struck me that this is sort of one of those parts that for a technical assistance provider is not so glamorous, right? As a TA provider, you don't really want to get those requests, which is like, well, give us an operational grant and help us cover our costs, because it doesn't necessarily have the glamour or appeal of other interventions. But glamour aside, I think it's more important to look at what the potential outcomes could be with those types of innovative products that kind of unlock the right kind of innovation. And that's sort of something that I'd like to dig into a little bit deeper when I get back to my office, is just to try and understand for myself when it comes to capacitating local capital allocators and helping them through that journey of that issue of fund allocations, and the balance between able to do kind of many small tickets that are highly impactful. I think that that's one element of collaboration that's really important to pick up going forward.
Thank you, Andrew. I'll probably come back to you on some success stories, and I'm sure SMEs in the room would be very interested to know how to access transaction advisory services, whether they have to be in your portfolio or pre-portfolio. And Nana, maybe for you as well. Matthew, quick question. The access to finance challenge, right? It continues to exist. You are an investor in businesses in Ghana and Cote d'Ivoire. Tell us a bit about how you see the role of DFIs evolve in the coming years to address this challenge, right? You as an investor, what do you want the DFIs to do so that you can do more to the SMEs that you want to finance?
Thank you very much, Sam. I think to be able to tell what we want the DFI, we need to establish the problems that exist as a financier using the DFI's money primarily, because I think that is a practice for most African or continental African fund managers for SME. Historically, we've all been funded by DFIs. I mean, I started with some friends and family, domestic, and also VCTF, which was a quasi-government entity, to spearhead that development. But when we established a track record, we got the DFIs to support. And I'm sure in the near future, we may be able to unlock commercial capital. I think one of the challenge we face is the absence of patient capital. And I think that DFIs by nature have been designed to provide the patient's capital. But I think the patience is not needed only by the fund source alone, but also even the entrepreneurs need some level of education and engagement to be patient themselves. Because we see people that come to you to request money that they need it for 2 years, or we can even pay you within 6 months. And yet, you 9 years on, you still have them. Right. And I think in the morning, some little comments were made and some points were made, which I got it. And also, my colleague here has just said something that Sam Yeboade alluded to yesterday, that capital allocators also need capacity building or need support. And that maybe in the current frame of work, they may not have that. What we forget is that the fund managers are also SMEs, right? Almost every fund manager we have on continental Africa, with the exception of a few, which in the early days were sponsored by banks and other development institutions, had all been SMEs, including Oasis Capital, right? So in the same vein where we require capital to, patient capital to also grow and be able to raise funds. And in fact, their nature is even difficult because it is one industry where you require top-tier talent to be able to execute the strategy, to be able to act at operational level, and to be able to act at the governance and compliance level. We tend to forget that. For some of us, it has cost us the sale of 2 of our houses to be able to arrive at that place, and we are still soldiering on to get to that level. In the same vein, when we are financing businesses, sometimes we are very quick to finance the brick and mortar. So the factory, check, go. Equipment, check, go. Distribution van, go. But we forget that that company needs a chief operating officer who comes in of $100,000, right? And that company is starting at early stage and startup. And so anytime I hear, oh, we are catalytic, we are looking at early stage and startup, what is the thinking? What is the rationale behind that? So all that are very necessary requirements that need. So DFIs, in supporting that, we may have to look at things differently to say that if there is a demonstrable track record for these people, much as the practice may be very new, we are willing to provide support in that regard. So yes, the source of fund must be patient. It should also be flexible. Sometimes the rules and the requirements that are set on, you have to meet this, you need to go this, we need to find it. Of course, every money has a purpose and intention. So if that is a thing, and we've tried a lot of foundation, we were not successful because they are very one tunnel. We want to achieve this, and that is fine. All we accept is that we are not your client. But if we can segment it in that context to say, one, we require source of capital that is patient. We also require talent acquisition and retention, as well as training. There's also a need for us, and that is a point I made earlier in the morning with respect to pipeline building, because we can have a pool of capital available to be given to SMEs, but the SME is not prepared. Only yesterday we had a meeting with somebody that on paper, I made notes, that is doing very good business, almost $5 million of revenue. I asked for a teaser, he doesn't have. Slide deck, he doesn't have. But he could send me his financial statement. So I should make sense out of that and learn from, so I need to have about 10 different meetings, write down all the notes, and do that. Can I do this for 1,000 pipeline? So there are institutions that are needed. And the argument that our dear sister suggested in the morning, that if banks, for instance, can contribute a certain, or financial institutions generally can contribute something into enterprise development support fund, that can be helpful. And I have said this to a number of my friends who are managing directors of banks in Ghana and say, when we present business to you, you say you don't have knowledge about this, so you won't do it. But why don't you get the KPMG, the Pricewaterhouse others to do research for you and do sectorial mining industries analysis so that you understand it? Because it doesn't make sense for you to finance a business you don't understand or a business you don't have information. And we all don't have. So, but you've made good money. So why can't you put something into the development? So the development side in deriving the pipeline is also one of the biggest problems. That we are willing to finance business, but which business? Thank you.
Thank you, Matthew. You've hit the nail on the head. But I can't resist saying that a $5 million business should have a plan, right? Should have a business plan, should have a teaser, should have a pitch, should have something that they're working on to be able to get additional financing. So over to you, SMEs. Quick question to Mamadou, and this is still in the same vein of SMEs and barriers. What are some of the main barriers you've seen in your work as an investment advisor? Barriers and obstacles hindering SMEs from accessing DFI financing. And how can these challenges be overcome? Are there any specific initiatives or programs that your organization has implemented to address these barriers? And I think we should move away from the kind of collateral questions and so on to what has come up a lot today. Readiness of the SMEs, ownership of the SMEs of the journey that they're going in terms of raising capital and what they need to do. Over to you, Mamadou. Are you there? We need some collaboration between the technical team. Should I put you on the spot, Tracy? Just a contribution, yeah.
You asked us not to talk about, the high collateralization and whatnot that's required, but that would have been my go-to.
Yes.
Today, yeah, it's easy for a DFI to finance a large ticket transaction. It's also, for the banks are getting, I don't want to say lazy, but because our government is still issuing T-bills, so what they will do, they will just prefer to go to very, simple transaction. So one way to do it is let's try to have a simple solution, scalable, smart, and sustainable, where we can work all the DFI together with the hybrid institution like this here, trying to have a mechanism, trying to address SMEs. So,
Thank you, Mamadou. We're just about to open up for questions, but I'm gonna go to Nana and Andrew on a couple of things. One is Nana, the investment readiness gap. Is there anything that you do pre-investment? And then two, how do you ensure that your investments align with SDGs while also achieving financial returns?
So yes, there is, and I think it goes to a couple of the points I had raised earlier on the frontier facility that we have, which really goes into investments that we're not currently necessarily in, as opposed to technical assistance generally for us goes alongside our commercial capital into a business. There are also a couple of other things that we do. Look, I recognize all of what Matthew says because we invest directly as well. So we sit in exactly his seat. And also sit in the seat of providing him capital. So we fully appreciate the nuances on the ground and the difficulties of investing in SMEs. What we do is we will generally let a company hire an advisor, a financial advisor, for purposes of transacting and raising capital. And we will actually pay for that or allow the company to pay for that out of the raise. So we will not pay the advisor, but out of the money that is being raised by the company, they can pay the advisor. We don't have a problem with that, including our own capital, because we recognize exactly what you're talking about. A lot of the time, we have great SMEs who simply don't speak our language, right? What they are good at is operating their companies and running their companies. They don't know a lot about finance. They don't have a sophisticated CFO, and they haven't been required to at the stage they're in. But the reality is that the ball game changes when you start to talk to institutional investors, and it goes to the fact that we are held accountable for the capital that we're given to invest and have to invest it responsibly and report on that. So we sit in a seat where on the one hand we see everything that is around us and want to do more, but we're also constrained on the other side by our own stakeholders, who are essentially taxpayers, whose money is being shepherded or stewarded by the Ministry of Foreign Affairs. So those are some of the constraints we manage for. Now, what are we looking for in SMEs? I think that's one of the questions that we had discussed before. For us, given we're primarily an equity investor, it's fundamentally a bet on a management team more than anything else. It is a management team that we can have confidence in around their ability to execute the plan that they have said they will execute. We want them to also be adaptable and resilient, because I think all of us in the room know doing anything in our markets takes longer than you expect it to, and it's harder than you expect it to. So we want people who have shown grit and the ability to come back from difficulties. We also want management that is aligned with us in terms of incentives so that we're pulling in the same direction. We're, of course, looking for a good financial return, because that's how we can reinvest the capital in additional companies and have even more impact. We're looking for a clear path to exit where possible. Now, that's difficult in our markets, I'll be the first to admit, but just like a PE fund, we're looking for that as well. And important to us, we're looking for ways in which we can add value. So to your second question, which is around the SDGs, for us, the choice of investment sectors is very aligned with the SDGs. So all of our sectors tied to specific SDGs. And I think recent research has shown clearly and unequivocally that you very much have a positive correlation between financial profitability and sustainability. So I think where we used to have to educate from scratch about that, that's less the case these days. However, we're realistic. Very few of the companies that we invest in, particularly in the real sector, like operating companies in agri or manufacturing, today have best-in-class standards around environmental and social or governance issues. So we're realistic about the fact that they may not be starting from a place that is similar to the West. In fact, we rarely see any company here that is. But we will work with the company to improve. So what we're looking for is alignment around the fact that it is a good thing to do, will take work, but they're willing to do the work alongside us. And we will put in grant money to help them do it. We will put in resources. We typically will make our board appointees not people in Norfund itself, external appointees who can actually be of specific value add to the company that we see based on due diligence, and we'll pay for that board member. It's not a company expense. We pay for it as well.
Thank you, Nana. That's very helpful. Andrew, I'm going to come back to you on impact measurement and reporting, but I want to see if there are any questions, because we have 10 minutes to go. Are there any questions in the audience to take this forward? Thank you.
Hi. I want to say a very good panel discussion so far. It's very critical. I come from a background of tech, where I've primarily raised VC funding from Silicon Valley and other venture funds on the continent. And one of the things that we care about a lot within that space is scalability, right? And in talking about scalability, you talk about unit economics. And even to a certain impact, a certain level, to what extent is your unit economics impacting outcome of revenue? So in that same vein, I'm very curious for DFIs, right? How you think around your level of impact, and especially to the most basic unit or scale, right? So for example, if you're investing catalytic capital into a very specific business, to what level of impact do you try to see that a business will be of benefits? Example, if there's a a textile company, and they hire, let's say, 1,000 tailors in one region of Ghana who used to earn, say, 500 cedis, right? Would you be able to measure, or do you require the business to measure to what level of impact have they been able to transform these tailors' life? Do they earn 10 times what they used to earn? That's really what I want to understand.
Okay, thank you. Andrew, I think you will respond to this.
Yeah, indeed.
Yeah, please go ahead.
I think it's a great question. And from my perspective, there are probably two angles to this question. So one is, let's say, the ESG question, where there's maybe a risk management element to it that as an investor, you don't necessarily want to be investing in a company or through a fund and in a company, and the labor conditions are so bad that people are being injured, and it becomes a big kind of gets press attention, etc. So I think that sort of addressing those kind of contextual and ENS risks really important, and in many cases for DFIs, it gets a lot of attention in the investment process. It's very embedded in the investment process, and then kind of beyond doing no harm and sort of ensuring a baseline of quality jobs. I think we then tend to look at other elements of what is the impact of those jobs, and what is the impact on potential livelihoods of household levels potentially, and to what extent is job security secured, and what are the additional benefits that may be given through the employment contract, and where are they coming from? So what's the baseline? And I think that in there lies something of an issue that speaks to that efficiency question, right? Because the infrastructure that you need to have really good quality data on that is relatively high. It can be improved through certain kind of technological routes as well. So typically that kind of may be embedded into the contract of the investment, but also we may be kind of evaluating that after the fact. with an evaluation study and trying to sort of understand and pick out what has gone well here and what can kind of be replicated, what has not gone so well, and what can we learn from that and try and share that across the portfolio and with our peers as well.
Thank you, Andrew. I think there was another hand.
Thank you
There are
very
two
much.
hands, so please go
My
ahead,
name
both
is
of you.
Yakubu Lanta Abdul Jabbar, co-founder of Colsys Ghana Limited. So far, this has been the best session I've witnessed since this program has started. By then, imagine a software engineering company building a mobile and a web application for the biggest insurance company. The same company building the best COVID-19 portal in Ghana, and yet the company is collapsing with 15 staffs and the company is collapsing. This is our story as a startup company in Ghana. We mostly visit places like this, but at the end of the day, getting access to people like you is very difficult for us as startups. So how are you going to help us move away from the challenges we are facing to be a very successful company? I hear Mr. Andrew saying that there's a lot of funding out there. In fact, we have been struggling to even get mentorship to be able to harness our talent into the global stage. How are you guys helping us in this? Thank you.
Thank you, Jabba. Next question.
Yes, hello. My question is for Ms. Nana from No Fund. I'm on the other side of you, Nana. All right. Hi. Yes, I think in your introduction you mentioned that No Fund lends to banks, specifically for SMEs. Now, there's a general knowledge the banks don't lend to SMEs. I wanted to hear from someone who has actually lends to banks to lend, and what do you do when they don't, when they're not able to on-lend?
Hi.
So make your questions brief and to the point so we can respond to all of them before the time. Thank you.
Thanks. Just reflecting on Matthew's discussion with banks, it made me think about the fact that we often emphasize what happens at the top of the pyramid, whereas in fact the bulk of the benefits may be improving what happens in the middle of the pyramid. So there was an interesting discussion of challenge funds, which have their benefits, but will typically help a very, very small number of firms. And the question is whether, the 99% anything actually trickles down, or whether you just have a good media story with plenty of photos to show for the challenge fund. So going back to Matthew's point about banks, one of the things I wondered is whether there's a role for getting banks to work with SMEs to standardize and improve their financial data. If you could persuade banks to give SMEs accounts, say with a 2% interest rate, positive, that would be nice, which was rewarding actually having systematic financial records collated and in one place and properly documented, you might be able to help the 50% rather than the 0.05%, which is where the rewards are. In terms of actually getting the jobs for the economy and so on, it's not the 0.05% who will generate the bulk. We've seen Silicon Valley, which has got, billions have gone in and job destruction has been massive. So let's remember that my question is, how do we make sure that middle is improved to actually generate the bulk of jobs we need? And can we work with the big actors to systematize that? So it's not about employing more and more employee support people, which can never happen at the scale we need, as I suggested yesterday, but it's actually about systematizing.
Thank you, Henry.
Okay, my question is for Nana. Just to say, you shared with us that you do both direct investments and also you act as a fund of funds. So if you could give an idea of the ticket sizes that you do in both scenarios. Thank you.
Yes. Quickly, just let's respond to each of those questions. So Nana, you can start and then we'll follow up.
Maybe I'll start with Grace's question. Yes, we actually do monitor how much of the capital we give to banks is on lend. And increasingly, what we're doing, which I'll be candid, we were not doing before, even though we wanted banks to lend more, we're increasingly putting in place punitive measures in terms of, and in many cases, an increase in the rate that we're charging the bank on the loan when we see that it is not used for the purpose that we had talked about. So that's one tweak we've more recently made. And then to your question as well. So our minimum ticket size globally, and we invest more than 50% in sub-Saharan Africa, is $5 million. However, for West Africa, which is our newest market, we entered West Africa when I joined, which is like 5 years ago. It became very clear to us that that wasn't a fit with what was in the market. So we have done everything we can to push down on ticket size. And where we are now on countries like Ghana and Senegal and the smaller countries that we cover within the region is $3 million. Now, do I personally wish it was smaller still? Yes, I live here. My family has many entrepreneurs and small business owners, so I completely understand the challenge. The issue for us is we get quite a lot of capital to deploy. And I know that may sound like it's not a problem. It's a better problem to have than no capital, clearly. But we then have to be, with small teams and small resources, efficient about deploying that. So we're able to use up that capital in order to keep getting more capital as well. So it's a bit of an unfortunate reality of the way we operate. And that's the same on the fund side as well. I think our smallest ticket size on an SME fund is maybe about 3 to 5 million as well. But we typically will do much larger. 20 to 30 is about average on funds.
Thank you, Nana. And Matthew, can I ask you to give some response to Henry and Jabba on one is broadening the middle base where you can get more businesses to invest in. How do we do it? And then for Jabba, how he's moved from a $10 million company to a struggling company today.
Okay. Thank you very much. I think on the with respect to the second question, what I think is that we as institution are open, in our view, to working with advisory firms, because as an investor, if you would like to go down into helping business build a business plan, and in fact, that was our original proposition, that you come to us, we're listening to your story, we help you to get financeable business plan. Then I realized that this is not practical. So clearly, if we can have institutions, and I think IFC and some other development institutions had historically done something before called Enterprise Support Services for Africa. And if we can have similar institutions that walk people through business development, capacity building all the way, then we can have a pool of financeable business plan. But at our micro level, what we are doing is that we've identified a few business development advisors that we regularly work with them. So they prepare pipeline, they send them through, we engage them very often, and that becomes a source of financing for us. At least having gone through that tunnel, by the time they come to you, they are reasonable in terms of their thinking, and particularly when they get to equity discussions and all of that, they appreciate and understand. And two, we are also more flexible in using different instruments. The bottom line is that I'm giving you $1. I want $2 or $3 at this period or at this point. So whatever you call it, whether you want to call it equity, you want to call it preference share, you want to call it a debt with incentive or any other, the bottom line is the same, right? I think in that context. With respect to the startup, yes, we do finance startups, but also from the same point that was made is that we sit in a place where we are managing somebody's money. It is not our own money. So we have a responsibility to return that money. That is an element of building sustainability. So if we would finance startups, the analysis and the review and studies that we do will be much more. So for example, we have funded a number of startup businesses, But with ordinary finance startup businesses that have been started by people who have established record in other businesses or even in the same field. I give you an example. One of our best performing business, both in Ghana and in Cote d'Ivoire, all of them were from startup, because you got a team that have over 25 years who have worked variously and have just pulled out together and say, we want to start this business, which is the same business they've done for the past 25 years. Right from day one, they would be able to run the business. Records show that for most banks in particular would require about 4 to 5 years before they become profitable. This bank was profitable in 18 months and is in tier 1 of the banking segment in 3 years. And why? Because it was set up by a team that have been tried and tested. So when it gets to the entrepreneurial risk and innovation that we are doing all over the world, it is funded by somebody, which is typically not a commercial money. So maybe we need to lobby the Hamdia and their institution to say, can you set up something? Or if banks can also put a gear up and say that instead of going to some villages to go and build a school building and build other facilities and just paint it with their brand, can they, in addition to that, also provide a certain line? We are not asking for even 1%, 0.1% of all bank funding or all other financial institution funding be put into a pool that helps with the development of institutions like that. Because how proud would we all not be if we found out that the platform that solves the problem for COVID came from Republic of GH? I think even our Niger brothers would jubilate with us, right? And immediately give us that we have won the Jollof competition.
You want to start a war? They came in peace, so they came in peace. They came in peace. What has Jollof got to do?
Okay. Okay, we're lucky it's after lunch and our time is gone.
Yes.
You can see that everybody is so interested in this. Thank you so much, my panelists, for your deep work. Thank you so much, audience. And the only thing I'll add is that the networking sessions, the coffee breaks, are for continuation of these discussions. So
yes,
please reach out to different people. Let's get some solutions going and collaboration going. Thank you so much. Good afternoon.
Thank you so much, Samuel and your team. Would like you to just step out, take your nice group photo. Let's go for the coffee break, but let's proceed as quietly as possible. There's an impact fund showcase happening next door. Is that it? Hello, hello. For cooking anything, did it include a jollof? Jollof today inside. All right. So we've got an impact fund showcase that's happening now next door. So let's try and proceed with a bit of quietness. We're doing breakouts now. Okay, before the coffee break. Okay, so we've got a couple of breakouts we want us to do right now. So we've got, so Anglophone breakout is happening here. That's on effective gender lens impact investments for profit and impact. The moderator is Amajampo. Speakers are Hamdia, Edith, Ukinebo, Ifeoma, and Tracy. Up on the stage, please, to be moderated by Amajampo before the coffee break. All right. Francophone panel is at the Omanye foyer to be moderated by Yakuba. Speakers are Boel, Boris, Ibrahim Kouara, Dawuda, and Belisa Rojas and Aisha Savadogo. Two of them are virtual, Dawuda and Belisa, happening at the foyer right now. We've got the Impact Fund Showcase happening now by invitation only for regional DFIs and fund of funds. It's a facilitated round table between regional development finance institutions with impact funds and ecosystem building initiatives. And then we also have the deal room, opportunities for businesses to meet with impact funds happening at Lagoon Bar. So Lagoon Bar for the deal room, opportunities for businesses to meet with impact funds. Omanye one next door for the impact fund showcase by invitation only. Right here is the Anglophone panel And the Francophone panel is at Omanye. So my apologies. It's the deal room is at the Race